Sorry, guys. So today we're going to talk about with Dave Pollio about some stuff. Before we do that, I want to make sure that everyone can get an idea of what's going on. This fourth quarter has been crazy. It's been interesting per se, right? Because there's been a lot of inventory coming out the fourth quarter. People are getting rid of stuff, and sellers want to get rid of stuff before the end of the year. So Nathan, what have you been experiencing with sellers recently?
Same thing. I've seen a bunch of tapes coming out that been able to review, which is great. And it's interesting because this is not unusual for fourth quarter. We see this often where the last quarter of the year, all of a sudden there's a bunch of tapes. People are looking to get rid of whatever on their books that they're just looking to clean up.
Yeah.
So it's been interesting.
Yeah. It seemed like sellers, kind of quiet, and then all of a sudden it just jumped up like crazy, right? I don't know what's going on, and we expect it to continue into the first quarter of next year, right? Yeah. So we'll see. We'll see how that looks. Have you been able to lock down deals and make bid offers that are accepted?
I've had a few that have gotten accepted. I'm more in the raising capital state right now, so I haven't been purchasing a ton, but plan to in the early new year. So looking forward to that.
I knew most people's kind of shut down this time of year and kind of whatever, but for us, it's been, sellers pushing, get things done, getting deals happen. And BK starting to open up for some stuff for us. We've also seen a lot of people getting interested in partials, buying, selling, structuring them and whatnot, because cash flow is needed. And some people just want to raise money to buy something else. Some people just want to buy a partial to get their money moving.
Yeah, I've seen that come up a few times here, just in the last couple of weeks, where people are looking for and selling partials, which is interesting because it's something we talk about a lot. I've never purchased one. I'm looking at doing that here in the near future, just because my structure is a little bit different. So now I can. In the past, I really wasn't able to.
Yeah, cool. So at least I'm out in Harrisburg right now visiting a few friends who are in the space as well. So it's interesting to hear from their, large level. They're buying institutional stuff and they're selling institutional stuff. And their inventory is the same way, right? They see a different track record, but they're able to buy, but pricing is still quite high. Expectations of sellers are a little different. So I'm sure you guys have all probably seen Pollio tapes, right? They come out regularly. They come out good. Inventory from them is always accountable. They're reputable people. They have sellers who they work with. So it's good to see that kind of information coming through. And I think for a lot of people, getting the information and understanding what it looks like, and how to work with, with SN, how to understand how the tape looks, what questions you should ask, what you should be doing. So I wanted to bring Dave Pollio on to answer some of those basic questions for a lot of people who are out there, per se. So, Nathan, have you dealt with a lot of people who didn't know who Pollio was or SN was for a while, and now all of a sudden it's like, whoa?
Yeah, the SN team has done a good job of advertising and making themselves known, which is great, and that helps a lot. Just in general, like we want to see deals getting done all over the place, and whether it's me or somebody else. Me would be preferable, but it's good to just keep the wheels rolling on everything and making sure that deals are being done in general. And that just kind of helps everything keep moving along. So it's always good to see deals coming out and the more the merrier. And we talk about this a lot, but it's a business where we're in competition, but not really. It's a friendly competition. We like to. At the very worst, we rib each other about deals. Yeah.
And, but we need each other too. Because without each other, we don't know what's going on.
Yeah.
Right. So, again, guys, we're doing a little different feed here. So if there's any kind of issues on Facebook Live, but we are recording this for any kind of questions or concerns. So, and Nathan's monitoring that part of it for me. So he'll monitoring all questions. He'll be monitoring all the questions coming in. Any concerns or issues, we'll post it. So without further ado, I want to introduce Dave Pollio from SN Servicing. Dave, I appreciate you jumping on a Friday afternoon and joining us for a few minutes.
No, I appreciate you guys asking me to join y'all. Again, I appreciate that.
Awesome.
So how did you get started, Dave? Because I know you've been around forever, but where did you come from? How did you get into it?
Wow, forever.
Yeah.
So I started really an opportunity where right after grad school, it was back in 1990, and before that, everyone thought, geez, if I've got a graduate degree, I can ask for what I want for a salary. But apparently those last 2 or 3 years completely changed everything. So I just took a job in the bond department at Bank of New England. And within 2 months, the bank failed. And so it was very interesting that I had known someone that had said, hey, listen, here's what's happening. The FDIC came in, they took over the bank. So they took over Bank of New England, Connecticut Bank and Trust, and all the main savings institutions. And they set up, so Fleet bought the failed Bank of New England, but said to the FDIC, listen, we'll buy it, but we can't buy the $8 billion of bad assets at that time. So they decided to start a company called Recall Management. So again, I was very fortunate that, I knew someone that was really saying, this is what's going to happen. They're going to start this in the next month or so. And so I walked up 14 flights of stairs for 2 weeks straight, annoying the guy that was going to be hiring people. And finally, he just said, all right, we'll hire you. So that was the start of Recall Management, where it took us 6 years to liquidate the whole $8 billion of bad assets. So, back then it was getting everything started where you had to now get people to invest. And so Wall Street, we used the Wall Street Journal to advertise. We started doing sales after the first year. And, that's how I met Rob Arkley from SN Servicing.
This was
probably 92.
Wow. Okay.
So he was one of the first characters that we were dealing with that was coming in to Boston and to look at all the different portfolios and files, because we would do about probably 12 to 20 sales every month with the FDIC. And so back then, of course, it wasn't digital. So someone would come into Boston and we'd have to, if they wanted to look at 2 assets, a lot of them were, large commercial assets or, some pretty tricky smaller commercial assets. Each loan would have maybe 30 to 50 files, and you just have to bring them all in, and they would go through. That was their due diligence. They would go through page, and at a certain time they would do a bid auction for them. And so we did that for 6 years. And SN with Rob was one of the big buyers. Bought a ton of assets in New England, where back then the market really changed quickly. I mean, it was down for about a year, 2 years, but if you bought stuff back then at 30 cents, 20 to 30 cents of the outstanding balance, that thing turned around to 60 to 70 cents within 2 years. So he really had a big jump start. So once that ended, he said, listen, since you're the one that actually helped me buy these deals from Recall, why don't you come here and start my acquisitions desk? So I did. So about 90, it ended in 96 and I started in 96 with SN, headed up their whole acquisitions group. We probably acquired about $500 million a year of residential distressed portfolios throughout the country up until 2008. So we were a big buyer, and we were buying commercial, leases, contract for deeds back then, regular conventional loans. It didn't matter to us. And so our system was created to handle every type of asset. So our system was really flexible, where we could have had a borrower that had 35 investment homes in Philadelphia, and we could handle that on one line, one asset code, which was a strong thing to do. So in 2008 to 10, of course, the market did another move there. And so we decided to kind of hold back on all of our purchases and kind of give it a little time to see what the market was doing. So we finally decided that, we're going to stop buying for now. And, let's go out and see if we can help the banks that we were buying from, if they'll allow us now for us to service their distressed assets. And so they did. So between a few banks, they gave us about close to $3 billion to service, which was great. And so now our platform was holding over 200,000 loans, about $3 billion in UPB. And for the next 3 or 4 years, that's when the big hedge funds came in and started buying up these chunks of deals. As they would purchase the deals, they would say, listen, we really like how you guys are servicing the assets. Can you service for us? So that kind of really pushed us into the third-party servicing side. The trading desk was really created out of those clients saying, listen, we don't have a business development group. We want to buy more loans. Can you help us? Mm-hmm. So I would take the relationships that I was buying from and match them up with the clients that we were servicing for so they could buy more loans, which of course, the more they bought, the more that we got to service, which then turned into them saying, listen, you helped me buy these assets. Can you now sell my assets after a couple of years of us servicing assets? And that hence the trading desk for the last probably 5 years, on average, crazy enough, it puts out about 250 loans every single month that are listed for sale. And the nice thing is that as you guys have your own platform for trading too, is that they're direct deals. These are deals that are coming directly from our clients. We know all the assets are there. We know the documentation is there. We know they're legitimate and they've got everything to back up the reps and warranties in a contract. So, a big advantage for someone just saying, listen, I got this from a broker, from another broker, which we hear a lot. And we understand that. I mean, I've dealt with that for years. It's out there. On our own side, we started buying portfolios about 2 years ago. And our purchase now is really up to about 25 million, probably every 6 months. And so we're kind of a niche buyer, which eventually will take many of the assets that we purchased over the last 2 years, and we'll put those on the trading desk.
So have you seen that change in the last 2 years? You 25 million a year, you said?
About 25 every 6 months.
Every 6 months. So then how's that fluctuated over the last 2-3 years?
For us, it hasn't fluctuated. We don't want to get to the size that we were before, where we were buying $500 million a year. We're very comfortable with working with our lenders for about 100 million. And again, that's also too, a lot of the lenders these days, lenders back when we were buying, were willing to do an open line for $500 million. Now we're doing lines of 25 to 75 million. So that's changed quite a bit.
Yeah.
Interesting.
So
that's really interesting.
So when you got into this space and started dealing with smaller buyers, what were some of the common issues, questions, and just understanding of where they were at and what they were missing on?
Yeah, I mean, it's interesting to see the one-off mom and pop buyer type that went back probably about, let's just say about 6 or 8 years ago. And that's when the big push, whether through Note School, whether through other groups, they're pushing how to buy loans. Mm-hmm. And, for every 100 people they had signed up as a student, as a buyer, I would have been surprised if 1 or 2 of them physically did a transaction. Yeah. And so the initial concern back then was that they were afraid they always thought they were buying too high. They were afraid that they were going to lose too much money on a transaction. Not understanding that, of course, as the years went by, the market kept going up. So every time that they keep changing their philosophy of what they're looking at, they're still a few years behind really where the buy side is. So as much as I can try to educate for people to go out there and make a purchase, just, you got to do the purchase to get the education, to physically know what happens, because it's amazing how many people just sit there and do nothing. And all it takes is 1 or 2 purchases. You get the feel, listen, you may make a mistake. I mean, listen, I have asked people, have you ever, every time you buy stock, does it always go up? No, sometimes you lose money. So it's the same thing with the notes business. It all sounds glorious because these big guys are buying like 1,000 loans and they're hitting home runs on half of them. And the other quarter, they could be just losing their shirts, which very interesting. You're not going to see that.
Yeah.
Nope. I hear some feedback now. There you go.
Yeah. But I think for newer, for new investors, it's scary to approach, people your size. When you get one tape in November with 900 assets, right? They get overwhelmed. Would you say for those people who are looking to get in, submitting an offer is just submitting an offer, right? They shouldn't be fearful of submitting an offer because they can't take down the entire tape. What will happen? And I think just doing it is a big step for a lot of people.
I get that. Yeah, I get that. And I that's definitely a concern. And so I keep it wide open. I tell anyone that looked at the assets, number one is ask me any question you want. Ask me anything about the process. I'm never going to put you in a situation where you give me an offer and I'm forcing you to fund the deal. We never do that. The other thing is that if you want to just test what you're thinking, put a number on it. Let me know that you're testing it and I'll accept it as, okay, it's not a real bid, but when all the bids come in, I'll let you know, here's how you lined up against everybody else. So again, I guess it depends what you're dealing with. I'm sure not everyone will allow that. So it's much as we can educate, the better they're going to be down the road for us.
On the other side of that, though, don't put in an offer if you have no intention of actually buying. Like,
correct.
This is for real. We're not messing around. If you put in a bid and you win, you better perform. Unless there's something really, weird or funky that comes up that kills the deal. Don't mess around and don't pretend that you're going to do something and then not follow through.
Yeah, don't bid with the understanding that you have another person that is going to be buying the asset for you or from you. It's just, it's never worked. It has never worked yet. Not once with me, that's for sure. And if you really don't have the funds behind it, just don't bid it. And if something happens during the process, be upfront about it. Don't go radio silent. Don't hide. Just be upfront and say, here's what happened. That's the best way to do it. Because in this business, it is such relationship. Relationship is going to drive everything.
Yeah, absolutely.
So when someone makes an offer to you, what is the typical process? I know each seller is different, right? What is the typical process that goes through when you do make an offer with you? And what expectations should they have to close a deal?
Yep. So when all the offers come in, it's my job to create a result file for the selling client. The selling client's going to look at those numbers and say, okay, Dave, on these 20 loans, I can accept these 10, and I need you to make a counter offer on these 10. So I'll go back out to the high bidders that have been accepted on the 10 and explain that your offer has been accepted. Now please start your due diligence. So we all know that there's going to be a due diligence period. Again, I'm not the type of group that's going to say, okay, you need to fund this tomorrow. Here's the agreement, sign it, fund it tomorrow. No, we're giving anything between a 14 to a 30-day due diligence period. That whole due diligence period is your opportunity to do all of the third-party research, all the work necessary to confirm what was on the tape. That's what it is. It's confirming the information on the tape because your bid was based on the information on the tape. So it's a process where the selling client is going to send you all of the files, all the documents they have. Nothing's held back for that. So if it's, nothing's redacted, nothing is held back where they're not going to show you. Everything they have, you're going to get. That's part of your due diligence. So at the end of that process, yes, you're going to come back to me saying, great, all of our information came in, it matched up with what you said, we're ready to go to closing. At that point, they're going to have a purchase and sale agreement, and those purchase and sale agreements are good. You know, they're agreements that I myself have used for the last 20 plus years. And so I know what I want when I used to buy loans in my agreement. So there's going to be some reps and warranties and some clear servicing constraints in there that give you a comfort level. On the second part of that is I will have clients come back saying, okay, I did my due diligence. My valuation came back 50,000 less than what you have on the tape. And guess what? There's 10,000 of past due taxes that we found. As long as I have that information and they present it to me and they show me the BPO or the valuation or the taxes, you know, 8 out of 10 times the selling client's going to say, you know what? They're right. The value is 50,000 less. There is 10,000 of taxes. So their reprice is now based on the new information. And as I said, 8 out of 10 times the client says, you know what? We can still sell it.
Yeah.
We'll move on. Where don't have that information and just walk away and say, I'm done. Because you don't know. You have no idea. The client may still accept that offer.
Yeah.
And again, it's a process. It's a process that the selling client looks at and says, hey, you know what? That person you brought me did exactly what the right thing was to do. I want to deal with them in the future.
Yeah. And it's not that the seller's trying to pull one over and give you a $50,000 inflated value. It's that something changed. You know, the seller had that information from whenever they bought the asset. In somewhere in that time, something changed. And so they're providing whatever they have. If you find something new, okay. But it's, you know, nobody's trying to pull one over on anybody. Like Dave said, it's relationship. If you get burned by the seller, you're never going to go back there. And the seller knows that, and vice versa. So it's everyone's trying to be upfront as possible to get things done, because we all just want to get deals done in the end.
Yep. Yeah.
Yeah.
So let's talk a little bit about when things go right. Funding, escrow, all the kind of questions that go along with that. What can they expect when that happens?
I'm not quite sure what you're asking.
So when you agree to something and the money's get wired, is it going to someone in the middle? Is it going directly to the seller? How is that working?
There's 2 ways you can do it. You know, a lot of people like to use an escrow agent. And so that escrow agent is going to hold the funds.
Yep.
And their goal is to make sure that before those funds are released to the seller, that the seller has given the escrow agent all of the documentation needed to perfect their lien or collectability. So once that happens, the escrow agent will release the funds to the seller. On the other side of that, we have many clients that have dealt with the same seller so many times that they know that, okay, I'm just going to send you the money. I'll get the documents in the next day or 2 or 3 days, whatever. And if there's an issue, I realize that you'll be there for me and you'll have some post-closing documents for me to perfect my lien.
Yeah.
And again, those are the same clients where if there's an issue and it's uncurable, it's a non-collectible loan, they'll repurchase the loan back. They're going to stand behind that because again, it's their reputation also they're trying to present.
True.
Yeah.
And I think for a lot of people, I think they're concerned or worried, but they have to understand these are sophisticated sellers, right? They know what they're doing and not make mistakes. They're doing their job and they're going to rep and warrant because their reputation's on the line too. If they sell something that has some bad paper, they're going to stand behind that reps and warrants.
Correct. Yeah. Correct. And, you know, it's also my job. And when you guys sell loans, you're trying to make sure that your selling client is someone that you could stand behind because it affects us too. If I start bringing, you know, I'm not going to name any names, or back a certain time, there was a few sellers that when you heard the name, you're like, oh, never mind. I'm going to pass.
Yeah.
So are all the loans that you're selling, are they all serviced by SN?
Good question. About 75% of them are.
Okay.
The rest are coming from other funds that we don't service for, but they're a big buyer on our trading desk.
Okay.
And then we get some banks or other institutions that say, hey, listen, heard about your group. Can you sell my loans?
All right. So one of the things I think, especially a lot of new people come in and they say, well, so what you're telling me is I'm buying somebody else's junk. What's the motivation? Why do people sell loans? And are they just selling off their junk?
Yeah. So, you're dealing with a client that bought a large package. And we all say that they're all buying in bulk. So they're buying 1,000 loans plus 1,000 loans, and there could be a good part of that where they're just taking on these assets that are not in their territory or their type of asset just to get the big deal done. So yeah, they could have a low reserve on those assets, which then makes sense for a niche buyer in that territory where that this other group is not interested in dealing with.
Yeah.
If you're analyzing for based on what you can recover from that loan, your pricing should not be seen as, oh my God, I'm buying their junk. You're buying opportunity for that recovery and that profit on your side.
Right. Yeah, I know, for example, I prefer lower balance. So I like loans where the property value is between 50 and 150,000. So to me, that's my gold. But I understand that for a different hedge fund that has a different model, that's their junk, and that's fine with me, because then then that's a symbiotic relationship.
Yeah, they don't want to. Yeah, they don't want to. They'd rather spend their time and money on the bigger assets.
Yeah, and to me,
and if they break even on those assets, it's a great deal for them.
Right, and to me, those bigger assets, number one, is the bigger ticket. And I feel like I've got more eggs in one basket that I'm not comfortable with. And then on top of that, I don't like dealing with that demographic as much as I like the lower value demographic. And that's a matter of preference, and how you want to deal with it, where you want to go.
And some of the junk loans are cleanup deals. Yeah, if you know it's a cleanup deal, whether it's a closing of a fund or just a cleanup of someone going out, the pricing is going to be reflected on that. So there's the advantage there.
Yeah, and I've been on the receiving end of those kind of deals as well, which is great. And again, it goes back to the relationship. They called me because they knew I was for real and I was going to buy. So it worked.
So it's when you say that, because a lot of people would feel that exact way, that this is crap loans. Why am I dealing with stuff that someone else doesn't want anymore? And I think people miss out on the fact that there's sometimes where they've already made the profit, right? And they're trying to get out of a situation where they're just done making their profit. They can sell for a gain and they're going to buy something bigger. So it may not be a situation where it's a bad deal or crap deal. It's just their time. Maybe they have to sell for whatever reason. Maybe they have some stuff on the books they have to get rid of. And sometimes it's bad. I think it's your due diligence to make sure it's not a bad deal, right? I think people miss out on that opportunity and understand that every seller doesn't looking to make you buy a bad asset. Are there bad assets? Absolutely. But you can kind of figure that kind of stuff out by just going through the process of your diligence, make sure the asset's in good quality. One of the biggest things I think most people get into is, the value, right? That's a hard thing to really go through and narrow down because no one knows the value of the property. It's extremely difficult to actually have it, right? When you're in due diligence, what are some of the typical things that buyers should be looking at and making sure that they're not buying something crappy, right? What are some of the key things that people do to make sure to prevent themselves from getting into a bad situation?
Well, on the valuation part, you always want to make sure you're getting pictures. You don't want someone to do an AVM. You don't want someone to do just a data search. You need someone to physically get out there and look at that property. And that BPO valuation should have condition comments. We all know we can't get inside the house, obvious, but some of these guys have the ability to say, you know what, there's a tarp on the roof, there's a car in the front lawn. There's just obvious things that are going to trigger. Or on the opposite side, it's going to say 2 cars in the parking lot. Looks like the place is well kept and looks like people are living there. I mean, these are things that you want to know. Also, on the 3 comp sales and the 3 comp listings, it gives you your opportunity to say, okay, are they giving me comps that are in line with my property here? Because sometimes, you know, if they're just doing straight REO comps, you got to watch that, because of course, all REO comps are going to be a lot less than the true value of that property. It's just the nature of an REO sale. And you want to see pictures also of the comps. So that's on the valuation side of it. This, of course, the next part is the tax title reporting. We call them what? We call them O&E reports. And so you want to see that report that's going to explain to you, okay, here's my first lien. I see it. Here's the chain, how they got it. There's an assignment from bank A to bank B. I could follow it. Great. It matches up all the numbers that on the tape that they gave me. I noticed that the town school taxes are all current. Great. Or it may show me that they're in default. The one thing that's hard to see is a tax lien that's been sold. So that's a tricky part. It's tricky for us. I mean, I've gotten screwed many times where, you know, I knew there was a tax lien sale of maybe 5,000, but I didn't really realize that, you know what, they were still charging 18% rate for the last 10 years. That's probably the hardest thing to find. In my experience. I mean, you guys, if you think there's new technologies or systems out there that can help with that, that'd be great. But everything else should be fine. You know, you'll see the HOA liens. You'll see if there's any code violations. So everything is there. Those are the 2 most important things to me, other than you then digging deep into the collector comments and the pay histories.
You know, it's a great point to make on the valuation. And Dave and I have had this discussion before with the BPOs. I do BPOs all the time, and Dave has his own system. But for me, the BPO is not just the number that the realtor put on there. It's the whole report. And like you say, then it's what are the comps? How far away are they? You know, what do the pictures look like? Did they take pictures of the neighborhood or just like the front door from their car window? Or did they actually get out of the car and give you some actual pictures? And so it's really the complete report that I look at, not just that valuation number. That valuation number, in fact, if it's you know, significantly off of what I thought the value was, then I'll pick up the phone. I pick up the phone often anyway, but I'll pick up the phone and call the realtor and say, hey, I'm not trying to sway your numbers. I'm not trying to, you know, be right. I'm just trying to understand. You know, I thought it was 75. You're saying it's 30. You know, so what happened there? Why are we so significantly different? And we'll come up with something there.
Have a good day. Thank you.
So it's interesting.
I get a package.
Yeah. Santa Claus arrived. That's awesome. So, you know, we haven't got to the elephant in the room question. I think we'll leave that for kind of last. But I think for a lot of people, you've seen the inflow of assets. What have you seen over the course of the last couple of years of asset? How many assets are available for sale? How many are actually selling? Do you see a lot of transactions, or is things slowed down from what it was 5 years ago?
It slowed down a little bit, but nothing major. What has slowed down is probably the executions of those transactions, where as the years kept going by, the pricing expectations kept going up higher and higher. And then, of course, you know, everyone wasn't willing to be at that level. And so, you know, for the many of the loans that we were selling, probably about probably about 50% actually physically would go through to the final funding part, where about 3 years ago and earlier, it was definitely about 75 to close to 80% were going through the transaction. So everybody is willing to list their assets for sale, but their expectations are following how they're trying to buy their assets. They're realizing that they're now paying more for their assets. And so they're saying, oh, you know what? If I'm paying more, I need to get more from my selling side. The interesting thing, of course, now is the second lien market, where it is the valuations that have really created an easier sale for my clients, because the higher valuations now have created equity, where when they bought these 3 or 4 years ago, they were buying them with zero equity. And so that's an easy sale for them. There's, for 100 I put out, probably 90 do sell. It's the first lien resi side where that valuation is driving everyone's expectations, whether it's the seller on what they're willing to transact, to trade it at. But no, the amount of assets has still been enough for me to keep saying it's about 200, 300 every month that we can list for sale. Now, of course, right now it's slow for the holiday, and it'll be slow probably till the end of January is my guess, and it'll probably start to kick back up early February.
So you say 200-300 every month. What do you say to those people that say, "Oh, there's just no deals out there"?
There is deals out there. A lot. Of course, most of the people that are saying that are the ones that don't want to pay the market value for that asset.
Yeah.
And so again, they're the ones that, a lot of people will pass. I mean, I've got 1,200 people that will probably look at a tape, and sometimes you'll see that, I've got 70 to 80 people that have actually bid. So it's showing you that there's always a consistent over 1,000 people that have the ability to look at the tape, but don't put an offer on it.
Yeah.
Which is, I mean, I don't want everyone to put an offer on it. That would really bog things down. But
how often, when you do get some bids in, are you going back and having the same, multiple bids from the same different, the same offer from multiple different buyers? How do you juggle that with the seller? And do you give preference to those who buy a bulk package, where if I'm buying 20 loans versus someone who might be buying 2, are those people getting a different deal, or is everyone across the board? And if you have multiple offers of the same value, same bid amount by multiple people, are you going back and asking for best and highest? How does that process work?
Yep. So I don't ever do a best and final. What I will do is actually the opposite. What you just said is that I typically go to the new buyer or the person that's buying 1 or 2 loans and say, listen, I'd rather go to them, because again, it creates more opportunity down the road to build up this more people that physically want to bid. So I'm not pushing them aside just because they're a first-time buyer or they're just buying 1 or 2 loans. I'd rather give them the opportunity that I know some of the bigger clients, they're always going to buy 50 to 100 loans. It's not going to change. Me taking 1 loan away from them is they're not even, it's a blip to them, where it's more beneficial for me to work with the smaller client and get them some assets. And so, yeah, I will go back and say, listen, we've got 3 people here that have the exact same bid. Do you think you have any room to come up a little bit? Yeah. And they say, all right, well, if I can get it for X, then yes, I can do it.
Are most of these sellers?
I don't then go back to the next person and keep juggling different numbers back and forth. I do it one time.
Yeah.
Are most of the sellers you're dealing with institutional, small investors, or a mixture of everything?
Most of them are mid-sized hedge funds. Most of them, but again, a good part of these sales, when you see me put some tapes out that have maybe less than 10 loans, that's coming from investors like yourself that bought assets in the past. And again, they're the smaller type investors. And I got some some that may have like one or two assets they just want to put on the market for sale. They don't realize that we'll do that for free.
Mhm. Not sure.
So-
Cool. And you'll list them for free, and then what's your take home on that? Like what do you
Yep.
charge the sellers?
I mean, you've seen every single email I've sent out. you know that answer. It's a 1.5% on anything that is funded. And, that's a flexible number where if they're buying more than 5 million, of course, we're going to drop that down. And if they're buying more than a certain amount, we drop it down. It's not, it's funny how I get some emails from people that say, hey, Dave, this person is trying to sell your tape and they're asking 8 points. It's like, it is mind boggling. For us, the fee is good, but really, again, it's the relationship, because if someone buys an asset from us, it kind of opens us an opportunity now to show our servicing side for them. So it builds up our servicing side also.
Very cool.
So another question we had, well, I've heard asked is, if we buy this loan, do we need to service with SN? Can we move servicers? What's your requirement on that end?
Never. We never we never say that the loan has to be serviced by us at all. It's always an option. Absolutely. We have too many clients that have, servicers throughout the country, different servicers throughout the country. So it wouldn't work out. We have a lot of clients that we service for that only want to buy loans that are on our servicing system. And for them, I think it's more of a comfort level, because they know when the loans are boarded into our system in Eureka, that they're pretty diligent on getting all the information that's necessary to service the asset. Because again, we're being scrutinized by the CFPB on how we're servicing assets. So we have to follow every rule too.
And it's just that much easier if you're buying something and keeping it with the same servicer. Man, it's a lot easier.
Yeah, no new phone calls, no letters of stopping payments. It's no reinventing the wheel again. If you have attorneys that you rather work with than the ones that we have no problem accepting that also.
Right on. Very cool. So where do you see this going next year? We're talking about end of 2021 into 2022 and beyond. Like you said, you haven't really seen a ton of variation. Are you expecting more of a variation in the near future, mid-term future?
No, I'm not. And so I'm probably on that side where people don't like to hear is that, I think it's going to be another 2 years. I really do. I don't see anything that is going to, and again, I'm looking at the mid-sized buyers to the small buyers. I'm not talking the big, large banks and hedge funds. I mean, they're gonna find their opportunities all the time, but as they have to pay more for their deals, of course, it's going to be harder for the mid-size and the small guy to buy an asset. So it's going to be tough. I think it's going to be tough the next 2 years. I mean, that's my opinion. I think you're going to continue to see product. Again, it's the execution part that's going to be on the slower side. I think we'll see a lot more second liens too. I do believe that they're starting to see that those executions are at levels where, it makes a lot of sense for them to move these assets off their books. I don't hear many people saying that, listen, I don't want to sell because I can't find those assets back in the market now. I think they're saying, you know what, I'm okay selling because I want to have the cash for when something happens down the road.
Yeah.
And I think, one of the reasons that the inventory is not going to increase, what you're saying is that these bigger players are really holding their own stuff. They're not selling as they used to. Inventory is just not moving as much as it used to. Do you see 2-3 years down the line that inventory changing, or it's unknown because we don't know what these larger funds are going to be doing with the inventory? Because like we both know, 10 years ago, the structure that they have in place now was never in place 10 years ago. there's more funds, there's more sellers than there was 10 years ago.
Yeah, I do believe that when I say 2 years, yes, my understanding and my belief is that after 2 years, it's going to open up a lot more ability for transactions to get done and for people to start making some purchases. I think the issue now is also with a lot of these large funds are really driven by a manager, and so they're fund managers. So, as a fund manager, your job is to get the money out, and what you're paying for it. It's not really held against the actual the fund manager, because your management fee is based on your portfolio balance. So there's not that big push where it used to be as a principal buyer with your own funds, you had to sell because you had to pay back your warehouse line. So it's different. There's these guys, they're not pushed. Something's going to have to push them, whether maybe it's eventually the funds gonna be like, well, listen, we're not getting the return or the velocity of these purchases. How do we change that? Interest rates are starting to go up, which is good. That's going to help because that's going to put a little more risk inside. With those rates being when they were at 3%, you can't lose. People have ability to refinance and move around very easily. There's no threat or risk on that side of it.
Most of the loans are selling, how delinquent are they typically, right? Reason I ask that is that in the coming years, when the loans that are created today go delinquent and they get trickled down, the interest rates are really low in comparison to what they have in 06, 07, 08. How do you see that changing things? Because you can't buy a loan that's a 3% coupon for what you bought it for in 08, 07, which was a 6-7% coupon. How will that change the game in the coming future when those loans trickle down and are purchasable?
Yeah, I mean, that time period is going to be extended. I think each delinquent loan that we're going to see going forward is going to be 12 months plus easily. And we've all seen stuff, and I list stuff that's 5 years delinquent. So getting back to the due diligence part of it, your due diligence is going to reflect, is there any action or payments in the last 5 years? Because otherwise it's a statute of limitation issue. You can't find anything. But so I think that delinquency is going to be a 12-month plus before they want to put it on the market. Also, what you don't see that we saw quite a bit from our original purchases back, before 2010, was that banks were more willing to sell assets that were 90 days delinquent, because once that asset on a bank line hit 90, it became a classified asset. That classified asset would be on a report every single quarter. And that quarter report would be in front of management saying, okay, we've got these 100 loans that are classified assets, which really meant they can't go back on the line. They're delinquent, and they would write them down, whether 10 or 12%. And those assets were live to be purchased. Banks, I can't find a bank that will do that anymore. It's a long gone where I can call up a bank and say, listen, can you show me your assets that are 90 days delinquent that are classified? It's not out there. It's not a big deal anymore to them.
Interesting.
So
after a while, these bankers would be, every single quarter would come up with the same 100 loans, and eventually be like, listen, this is crazy. Let's just get rid of them. So I'm going to keep talking about them.
Yeah.
So I'm going to ask the elephant in the room question, right? How much are loans selling for nowadays? What is market
50
value?
cents. 50. 50. Okay, there you go.
Right.
That was easy. That's really easy. 50.
Everything's 50.
50. Yeah.
It's such a hard question to answer because there's so many different things going on, right? It's a struggle to get that answer because every seller is different, every deal is different. What are performing assets selling for? What are non-performing assets selling for versus CFDs and all stuff? What are you seeing a performing asset that's solid first position selling for at a yield price?
Yeah. So You're right. That's a question that I think people that know me probably don't ever ask that question anymore with me. I get in my soapbox and I just say, well, if I say 50 and you all bid 50, that's a fun deal. It makes no sense. So I've always pushed the theory that don't ask me what the loan is trading for on balance or valuation. Understand that what is a loan trading at your projected recovery? You have to have a sense of what you're going to recover from that asset. And so if I'm going to recover $100,000 and I'm telling you that you can buy it for 75 cents of that, okay, that's a conversation I can talk about. I'm not going to say that they're trading for 50% of what the SMA recovery is, because that's too low. I'm not going to say they're trading at 100% of some's recovery, because that's too high. There's no profit there. So that way, each person's going to have their own sense of a model of what they can recover. And so that's why when someone says to me, what is a UPB? It's changed completely, because you could have non-performing loans that have a valuation 2 times the unpaid principal balance, but it's also still above what the legal balance is. So I have people that will pay 125% over UPB, because they know, they use the word, they understand recovery. What is my recovery going to be? Not what is it trade for UPB or BPO. So I'm sorry to get off on that little tangent there. But so a good example is, let's use reperforming loans, because a truly performing loan, if we're selling a truly performing loan, it's a bank loan that someone's going to pay 100% as high as to 102%, depending on the rate. They're just rate driven. They just want to get the rate, the yield on that, and that's it. They don't really care about the asset type it is. So when we sell those, they're not part of our tapes. What we're selling is reperforming loans that now are starting to make their payments, whether they start to make 6 months to 12 months. Those have been trading anywhere from 85 cents of UPB up to probably about 94%. I get some people that will pay up, a little higher than that based on the collateral value and the rates, but that's a good sense. So that's why people like to take loans that they've had from 2 or 3 years ago, where they bought as NPLs, they get into RPLs, they know that they're going to get an execution of 85 and higher. Non-performing loans, that's where it's hard, because again, I have people that will do trades at 20 cents of UPB, and some that will do trades at 125% of UPB. So it's really going to be, again, based off on what they think they can recover. And some people have formulas where they say, listen, I'm going to pay 60% of value, or what's less, 60% of the UPB. So they kind of bounce it off on that side. The second liens right now have been trading fairly aggressive. So most of the second liens that we're selling have some life and some payment and equity in it. And those have been trading above 65 cents of UPB right now. Yeah.
Wow.
Yep. They love the equity.
That's a performing second.
That's like an RPL, not sort of performing, not a true performing loan.
Okay.
I'm assuming that's also what it, first is performing and everything is clean, everything looks good.
Yeah.
Where that number is very high. I mean, firsts are selling high, right? But seconds for selling that high, I mean, that's unreal. It's crazy, but I get it, right? It's just real estate in general is high.
Yeah.
We were talking last night about the fact that assets are selling so quickly that everything's selling higher. So our numbers are going to go higher, right? You're not getting the pricing you did a couple of years ago. But you have to make sure it works for you, right? You're not going to get the returns that you did, but that's okay. As long as you target the returns you need, you're going to get deals happening, right? You're just doing your homework, getting involved. I think a lot of people get stuck on what should I bid versus what should I aim for my return. If I hit my returns, it's okay to bid 100% of UPB. If the coupon's at 8 or 9, of course you could bid that high. I think a lot of people miss on that factor because that coupon rate changes everything. With a 3% or 10%, that percentage UPB jumps. People just got to do the homework and figure that out. I think pricing is just what people are willing to pay, especially if they're not able to buy a lot. They're going to price it high to make sure that assets because their cash is sitting there.
A lot of times the question I like to ask is when they're on the phone with me and they're saying, well, I can't bid that. I said, well, okay. So the borrower has a UPB of 100,000. The property is worth 300,000, and the legal payoff, which is legally due for a payoff, is $200,000. So you buy that loan, they call you up the next day and say, I won the lottery, I want to pay you off. What are you going to ask for that payoff? Are you going to ask for the 100 only? Or are you going to ask for the 200? Like, well, no, I want the 200. Well, okay, that's your recovery. They just can't get past that they're paying more than the unpaid principal balance.
Yeah. No, I get it. I get
Well,
that.
it's amazing, to have that conversation and making people aware that it's okay to bid what you feel is best for you. Take into account the fact you're not going to buy assets at 20 cents, right? That's not happening.
Right.
For most part, unless it's dirty and all that stuff. But I think some people are afraid to make an offer that's less. How do you handle when an offer comes in at 20 cents? Are you sitting at the seller, or is that kind of getting pushed off? How are you juggling that situation where if I'm making an offer at 20, Nathan making an offer at 65, but I'm the only offer on this asset? Are you squashing that bid because it's too low, or how are you handling that?
No, I present everything. And so the reason I present is because they may counter. They may counter at 35. It gives you an opportunity to say, all right, you know what? I think I can get to 35 for my 25. Yeah, no, I would present everything. There's no reason. And, people always say, well, I don't want to waste your time. That's why I want to know, what are these trading for? And it's like, it's not a waste. It's not a waste of my time at all. It's never a waste of my time. And it should not be a waste of your time because it's an education. Like, well, I don't want to go through these 10 assets if it's going to be, something that's too high for me. Well, again, it's an education. Go through the process. It's not going to take you more than an hour or two just to open up the tape, analyze it, and come up with a number that you think you might want to buy it for. Again, you don't have to present the offer to me as a live bid. You can just say, hey, Dave, I ran through the tape. I think it should trade at 20. It's not a waste of my time. It's not a waste of your time. It's free education.
I think people miss out on that, right? Most of us went to college, right? You spend a lot of money to not make any money while you're in school.
Yeah.
So if you're going to make an investment and something goes wrong, that just the experience itself to just do things is worth the money. Again, college is something you paid for every single semester and you weren't making any money during that process. So why are you taking this any differently, right?
Absolutely.
Make the offer, get the trade happen. If you lose money on your first deal, that's okay. But you learn what to do, what you did wrong. And you just have to adjust and speak and ask questions. You guys have been awesome. When an offer comes in, you have no problem telling us what the winning bid is, which helps us as buyers to know what we should look at and go, hey, that's way too high. I could never offer it. Or, oh, wait, all I can do is just one or two numbers here and I can make that work.
Yeah, and I probably would like to rather hire somebody that said, you know what, I've analyzed 2,000 loans in the last year and a half, where someone says, yeah, I've gotten 10 emails.
Yeah.
Just open it up.
Yeah. Well, I'm going to end it there. I'm going to disconnect from the Facebook Live. We'll hang out for a few minutes. Hey guys, this feed will also be put on a YouTube channel, so make sure you check that out. I know we have some Facebook issues. But definitely tune in. If you have any questions for Pollio, reach out to us, me and Nathan, and we'll get you in contact with them.
Yeah.
They're friendly. This is the atmosphere we're in, right? So check out the tapes. Tapes have been flying around. Just get involved, right? Get in there, ask questions. Pollio's been awesome for asking any kind of questions you have. The only question you want to answer is, what should I bid, right? That's not the question for him. And just understand that Pollio is not the investor, right? He won't tell you. One of the questions we saw on Facebook was, how long does it take for a non-performing loan to switch over? There's so many answers to that question that he can't answer what the situation is, right? He's not there to teach you the basics. He's there to tell you trading platform. He runs that. He's the trader situation. So feel free to reach out to him, shoot an email, give him a call. He's been really friendly. So with that, May 8th, we'll be back in a couple weeks. Pollio, hang out for a minute.
Yep.
Hopefully everyone tune in and we'll talk to everyone soon.
Thanks,
Appreciate it.
everybody.